Last month, the IMF cut global growth for this year to 3.2% and for next year to 2.7%, which was the slowest growth in 20 years if you exclude the COVID and the Lehman crisis years. The IMF has also cut India's GDP forecast to 6.8% for FY23 current year and to 6.1% next year. But India still stands as a refreshing growth story compared with most other large economies. The question we are asking today is, can India reach the coveted 7% growth in a slowing world with fragmenting trade? To answer this, I have with me an economist who is an expert on both global trade and on India. I have with me Dr. Arvind Panagariya, the Jagdish Bhagwati Professor of Indian Political Economy at Columbia University, and of course, the former and first Vice Chairman of the Niti Aayog. Dr. Panagariya, thank you very much indeed for joining us. Despite you being in India, we have to do this remotely. That's unfortunate. I couldn't come over to Delhi. But the first question really is to understand global trade, since you look at it very closely. Now, the latest salvo coming from the US has been this chip export restrictions to China. Are we headed to an extremely fragmented world trade in the coming decade?
So, Latha, at one level, yes, fragmentation is happening. We saw the trade sanctions imposed by the United States on China, China retaliating. Prior to that, we had those steel tariffs by the United States. Other countries have also done this. So when you look at a micro kind of level, including, of course, the very recent actions that may happen on microchips, so at the micro level, you do see this fragmentation happening. But at the same time, if you look at the aggregate picture, trade has its way of finding, different routes. And just to underline that point, the aggregate exports, the peak prior to the COVID pandemic was about $19 trillion for merchandise exports. This was in the year 2018. Now, 2021 was still kind of continuation of COVID, but already in 2021, the aggregate exports had jumped to $22 trillion.
Okay.
And that trend has continued in the year 2022. Certainly, I've seen the figures for the first quarter of 2022, and there had been some 16% expansion in these exports again. So yes, some bit of fragmentation going on, but determined exporters and determined importers have gone ahead and found their different ways to carry on with the trade, and the overall trade has been actually expanding. So in this sense, I think I'm less worried. We are starting on an optimistic note in that case. Thank you for that insight, because we only get to hear the noise between countries, yes, but not the underlying peaceful trend. So parts of globalization are not getting reversed. Now let me come to the global growth issue. We've seen Fed tightening and tightening by several other major central banks, ECB, BOE, and China has its own problems. Are we in for some, is this decade going to be a decade of slow global growth? That, I think, is correct. With that, I concur, because, we have seen phenomenal Chinese growth, and the US has done recently as well. Europe, as usual, has been, not in the same league. And all that, the two big entities, China and the United States, have driven growth at a faster pace in the coming decade. Certainly, China looks set to slow down, and given the fact that it had been growing at 8 to 10%, now this kind of slowdown is going to contribute to the slowdown of the global economy. Also, China, now with $17 trillion GDP, is a major contributor. It's no longer the $4 or $5 trillion economy. So on that count, yes, I think. And then also, the policy measures that are being taken both by Europe and the United States, which is, because of inflation, they're all trying to tighten the monetary markets. Interest rates have been rising. And that certainly, and the Fed in the US certainly is trying its very best to bring out recession so that inflation can be checked. So yes, I think, we will see some slowdown of the global economy. There is no doubt.
Okay. So now to come to the India question. Is it possible for us to maintain or even aspire to a continued 7% growth, at least? I mean, we would ideally like 7 to 8%, but 7% growth in a decade when global growth is slowing?
Yes, so there I'm optimistic. I'm quite optimistic. In fact, you had raised earlier even the issue of 7% growth rate in the current year.
Yes.
My own take actually is that in the current year, we would very likely hit 8%, and between 7 to 8% in the decade to come, I think is in my view, well within our reach. Indeed, it's the likely growth rate to happen.
Okay.
If you'd like me to explain why, both on the current growth rate being likely to be closer to 8%.
So one minute. Maybe let us do the near term first, and I will come to the medium term prospects in a bit. In the near term, my worry would really be that exports are plateauing for exactly the reason we discussed, that destination countries are slowing. So if you looked at the July, August, September export numbers of India, they're all around that 33, 35 billion. We're not able to progress beyond that. Likewise, consumption within India at the lower echelons is not very good. That's why there are doubts over the 7%. But why do you think we can still overcome?
Right. So first of all, on exports, there has also been the fact that the currencies of the other countries have depreciated more than India's currency. Yes. So that's something that India can do something about. We should allow rupee to depreciate at least as much as the competing countries let it depreciate. But export is only one of the components of the aggregate demand, and the way I see it is a little differently. So take the first quarter of 22-23, we have already had 13.5% growth rate, and now in rough sense, if you do this calculation. What we need is the growth rates of the 4 quarters to add up to about 32, right? And divided by 4 gives you about 8%. So 13.5 out of the 32 percentage points has already happened. Question is that in the remaining 3 quarters, can we now, feel something like 21.5% additional growth? That growth rates. Well, if you look at the second quarter, the base we are starting off with is still relatively quite low. Last year, the GDP in the second quarter, that is in the year 21-22, was only 1.5% above the 2019-20 second quarter. So, pre-COVID, we have hardly, recovered to the pre-COVID level. So it's still a very low level of GDP with which we are working in the second quarter. And so my kind of inference is that if I also look additionally at all the indicators that are coming out, export is one, which is a little tepid, but all the other indicators, if you look at, tax collection, flights, how the airline industry is doing, how the transportation industry is doing, particularly the passenger transport and all. They're all, high frequency indicators by and large are showing pretty robust growth. And so I think given the low level of the base and generally positive indicators, whatever we have so far for the second quarter, suggests to me that 7 to 8% growth during this second quarter is entirely feasible. with that, we are left with, doing another 5.5 to 6% in each of these remaining quarters. So that gets us to almost 8%. So, I'm pitching for 8. So
Okay.
7 certainly we will cross.
Okay.
So
Well,
it's purely arithmetic.
Yes.
Also, by the way,
Uh,
if you look at the sectors, one large sector, transportation, hotel, broadcasting, etc., that is still about more than 11% below the pre-COVID level.
yes.
Likewise, you got construction, very large sector, which has come to only about 3.5% above the pre-COVID level.
That's right.
Mining, quarrying, electricity, power, all these sectors, they are all below, all about, less than 3.5% more than the pre-COVID level.
Yeah.
So enormous scope for catch up. So with all that, it seems to me that, in the remaining 3 quarters, we can certainly get growth rates of these 3 quarters adding up to something like 21.5%, which will get us to 8%.
Okay, well, that's music to our ears. We do hope it pans out that way. At the moment, the RBI's forecast for the second half stands at only 4.6%. There are some fears. I'll do one thing, sir. Let's take a break on the optimistic note and come back with what the skeptics worry about. Back in a minute. Welcome back. I have been speaking with Dr. Arvind Panagariya, the former and first Vice Chairman of Niti Aayog and, of course, Professor of Indian Political Economy at Columbia University. Thank you for your patience, Dr. Panagariya. Your arguments that we should be able to do even better in the second half are very compelling because the lead indicators, as you pointed out, tax collections, auto sales, freight, PMI, Purchasing Managers Index, both composite and services, are all showing good growth. But where we have not seen growth, and here I'm going by micros, the second quarter numbers have just come in, are still coming in. Practically everyone who caters to the bottom of the pyramid has done badly. This week, we interviewed Godrej Consumer, which announced numbers. We've spoken to Dabur, Marico, Hindustan Unilever, even two-wheeler companies bemoan that although their exports and higher value bikes are doing well, entry level is absolutely not picking up. They don't even want to look at that element, is what some people say. We spoke to a footwear guy, Relaxo Footwear. He's like in pain about the bottom of the pyramid. There seems to be a serious rural slowdown and a lack of purchasing power in the lower half of the economy, the lower middle class. Do you think that can stymie growth?
Well, Latha, in any year, even when the economy overall is booming, you will find pockets which are not doing well. So my approach is to look at more at the aggregates. And on the aggregate, I see good news generally.
Okay.
I'll give you 2 more. You named many of the other indicators. I'll name 2 more. One is the investment. The investment to GDP ratio in the third quarter of 21-22 was about 30%. In the fourth quarter, it went up to 33.6%. And in the first quarter of 22-23, it's 34.7%. Now, that 34.7% is, as we have not seen this in recent history. If I go back about 10 years, probably there is not a quarter investment to GDP ratio has been that high. Similarly, now, the MOSPET conducts this periodic labor force survey, PLFS, and they are actually now doing it with fair regularity, the urban unemployment rates. The urban unemployment rate in this survey for the last 4 quarters has been continuously, unemployment has been declining. And the last, which is the first quarter of the 22-23, they have put out an unemployment rate based on the current weekly status at 7.6%. Since the survey started, this is absolutely the lowest urban unemployment rate that the PLFS has produced. So it seems, these aggregate indicators certainly show to me and persuade me that the fundamentals are moving actually not only in the right direction but at a good pace. That doesn't take away the fact that in some of the parts of the economy things are slower, but possibly they will be pulled up as we go forward.
No, I take your point about the current GCFC, gross fixed capital formation as a percentage of GDP, was good. But we have been slowing for some time now, sir. From 2016, when we were 34.4% gross fixed capital formation as percentage of GDP, and the table is running as I speak, it fell to 33 and then 28% and remained at 28% for 3 or 4 years. It's clambered up, yes, to 32% in FY22, and the first signs in the first quarter in the current year look good. But if you look at the PLI investments, they're not looking very good. We have not heard any major announcement from the steels and the cements and the paints. We have only heard from renewable, very good investment announcement. Therefore, I want to ask you again, where does your confidence in the medium term lie? Because we have not really gone back to the early 2000s kind of investment rate.
But early 2000s, we also had 8% growth rate in 2003-4 with just 28% investment to GDP ratio. And it did not climb up to the kinds of levels you are thinking, which is like 36, 37%, till about 2007-8. That was a bit later. So with these kinds of investment ratios that we currently have, we have seen growth rates of 8% for sure. But let me again sort of reiterate, that if you again look at some of the groups, Tata, for example, has been investing quite heavily. Adani Group investing quite heavily. Also, by the way, there has been a massive restructuring of the economy in the last 4 or 5 years. Tata again, has shed some $10 billion worth of legacy assets. So a lot of the weak investments have been taken out, paving the way for more robust new investments.
Yes.
A lot of the unviable investments have seen the exit through the IBC process. A lot of the poorly managed but viable units like the Bhushan Steel, SR Steel, they have been now taken over by the more able managers. So a lot of this restructuring, and often if you look at the history of our own 2003-4, when we started growing very rapidly, good bit of restructuring had happened. The banks had been recapitalized and so forth, and then you got the investment cycle going. Here also, again, the banks have been recapitalized. Banks look much more robust. Credit growth has been happening. Double-digit credit growth has come back.
Yes.
Take the South Korean example. After the 1998 crisis, South Korean economy went through phenomenal restructuring. In fact, a lot of the very of the weak chaeballs that were there, they saw an exit. And lo and behold, then after that crisis and that restructuring, came out of the middle income trap and began to grow much more rapidly. And today, of course, per capita incomes have decisively moved out of the middle income trap levels. So I think a lot of this restructuring also tells me that the time for the investment cycle is right now. And as I said, both in the unemployment rates as well as the gross investment rates, both the trend as well as the level make me rather optimistic that perhaps we are in for a renewed investment cycle of the kind that we observed in 2003-4 onwards.
No, there's no taking away that corporate leverage is standing at its lowest in many years. And the bank credit growth is now almost touching 20%. We are at 18, 19%. State Bank announced 20% in their latest numbers. So, yes, credit growth and leverage are indicating that we could be at the start of something good. But only I have not heard big capex announcements. The other part, and I think I'm running out of time. So, the last question is on PLI. You were a little worried about the way the scheme was structured and the worry that people may be dependent too much on tariffs. Now, the latest numbers we have from the CEA indicate that only 15% of the expected amount has as yet been invested. And the number of jobs created were expected to be, something like 50 lakhs or 60 lakhs. The number of jobs created are now standing at just about 2 lakhs. Do you think this will deliver the manufacturing promise?
I think much more needs to be done. On manufacturing, we need to a hell of a lot more. And my swan song has always been that, look, we need to pay much greater attention to the labor-intensive industries. I've talked even during this visit to our largest exporter of apparel. The impression I form is that, for instance, there has been no foreign investment coming into India in these labor-intensive sectors, but competing countries like Vietnam and Bangladesh are showing fairly robust foreign investment, meaning multinationals coming into these sectors. So there is something fundamentally different in the Indian economy, and one of the key things I still think is very important is the labor laws. We have not notified the new codes. Particularly, code on industrial relations needs to be notified. And some of the states then will need to take a bit more initiative in raising the limit on this restriction on hiring and firing from 300 to something like, running into a few thousands at least. I hope that states like, once the laws get notified, which I hope happens fairly quickly, fairly soon, then the limits will have to be raised by the states to at least a few thousand states like the Uttar Pradesh, Gujarat, where there is a vast workforce which needs employment, good jobs. And there is something that needs to be done. We can't solve, in a way, the manufacturing problem has to be solved also to solve the good jobs problem.
Absolutely.
Our unemployment rate is certainly not high, but the jobs that we have are very low productivity, low wage jobs. And if you really, for those at the bottom rungs, which is really, vast workforce that is still in agriculture, about 40 to 43%, many of those have to be moved eventually into industry and services and labor-intensive ones, because that's where you're going to ultimately be able to employ them. You can't employ them, move them into things like IT industry or finance industry. And that, of course, means ensuring that labor-intensive industries as well as services do a lot better than they have been doing so far.
Yes, so we are banking that digitalization and more export of remote jobs to India will create enough jobs, and that will create a multiplier effect. But as you say, sir, labor-intensive creation of jobs, labor-intensive industries should perhaps bring home the beacon. Thank you very much for joining us and explaining what are the very good chances of India achieving a 7 to 8% growth in the coming decade, and where we have to correct our policies. Thank you very much for joining us on this edition of Indianomics.